Susan Galt-Brown, and I'm a partner at Stradley Ronan, chair of their FinTech group, and I want to welcome you to the Digital Assets panel. Before I introduce my colleagues up here, I just wanted to let you know that this session is eligible for continuing education credit. And if you'd like credit, then listen for the code words that I'll announce during the session. And the first code word is, if everyone's got a pen, absolute. Okay. So I'm up here with Tara Varghese, to my left, who is a senior counsel at the SEC's Division of Investment Management in the Office of Chief Counsel. And also Rick Edelman, who's founder of Digital Assets Council of Financial Professionals. And I want to turn it over to Rick and give each of the panelists a chance to introduce themselves.
Thank you, Susan. Good morning. Prior to forming DAC-FP, I created what is now the largest RIA in the country, Edelman Financial Engines, which has about $300 billion in assets, or did until recently, and serves about 1.4 million clients in both workplace 401k plans and individual clients. And I left EFE after 37 years last year in a long-planned exit to focus on digital assets. DAC-FP is an educational organization that I formed 4 years ago to provide education in the field of blockchain digital assets for financial advisors and their firms, to help firms craft strategy and to understand how to incorporate this new asset class into client portfolios and business models in a compliant way. And so we offer, among a variety of other educational opportunities, our major focus is our certificate program, the Certificate in Blockchain and Digital Assets, which is an 11-module online self-study, self-paced course offering 13 CE credits with a world-class faculty, no product sponsors or product mention. It's product agnostic. It's strictly educational. The first half of the course on the tech, what is Bitcoin, what is blockchain, and so on. And the second half of the course is all about practice management, the investment thesis, investment portfolio construction, compliance, regulation, taxation. So I'm happy to be here today.
Thanks.
And my name is Tara Varghese. I'm a senior counsel in the Chief Counsel's Office in the Division of Investment Management. I've been working a lot on crypto issues these past few years. There's just never a host of unique considerations that come up in this space. And I'm also a delegate to the SEC's FinHub, where we work across the divisions to comprehensively think about crypto asset issues, and excited to be on the panel today.
Great, thanks. So we have a manageably sized room. If people have questions as we go along and you want to just raise your hand and ask them, that is fine, or we'll hopefully have time at the end as well. Okay, so digital assets, what are they? Which is actually not a simple question. It's kind of fundamental and still not totally knowable. The term digital assets, if you look at some of the SEC releases and even the CFTC releases, they'll provide a definition that basically refers to an asset that is issued and transferred using distributed ledger or blockchain technology. And then goes on to say, including but not limited to virtual currencies, coins, and tokens. So that's a fairly broad definition. It should be noted, I think, that it's not a statutory definition, and it's not a regulatory definition in that it's not in a rule or regulation. These are just in pronouncements that are coming out of the agencies, but there hasn't been any notice or comment on what the definition actually is. So, and listed on the slide is a couple of the places where you can find that definition quoted. There's also a subset of digital assets that are called colloquially, because again, it's not a formal definition, but digital asset securities. And those, I believe, are just simply defined as securities, digital assets that are securities that are issued and transferred using distributed ledger technology or blockchain technology. So we're going to hit on this probably throughout the presentation, but what when you're looking at a digital asset and you're trying to figure out what is it, first of all, is it a digital asset? And second of all, is it a digital asset that's a security, because we care about that for purposes of our investment advisor regulation, since investment advisors provide advice about securities. So we'll move on to just a quick review of some of the types, and this is not an exclusive list. This is just meant to be instructive. And Rick, I don't know if you want to.
Sure. It is fascinating that there's so many different ways to define it. The IRS has a completely different set of definitions compared to what the SEC has suggested. And we can break it out more in a practical sense of these four categories. Cryptocurrencies it shows here, which are really, I refer to them as as digital assets, meaning an asset that has the traditional features of other assets, meaning store of value and volatility, changing of price. So Bitcoin is, of course, the largest. It's the original one. About half of the entire market cap of this category is Bitcoin. The second biggest and pretty much the second oldest is Ethereum, going by the ticker ETH. And that has probably 20 to 30% of the market cap. So between Bitcoin and Ethereum, you've got 70 to 80% of the total asset class represented by just those two coins. And then you've got about 13,000 more. And so that's a whole nother conversation. But all of these have the same basic two category features. They are considered a store of value and or they have prices that fluctuate. The alternative is the one at the bottom of the list, which are stable coins. Tether is the biggest. USDC, meaning US digital coin, is the second largest. These coins do not fluctuate in value. They are meant to peg their value to the US dollar. So they are designed, as the name implies, to be stable in value, allowing someone to place their money instead of in the US dollar, to place it in a digital currency that is a digital proxy of the dollar but pegged to it. There is debate as to whether or not they can truly peg themselves if there were a run on the currency, for example, but there is a huge amount of money that investors have placed into stable coins. DeFi tokens are tokens that represent an entirely different sector of the marketplace called DeFi, decentralized finance. Picture a typical exchange, such as the New York Stock Exchange. There are crypto versions of that. Coinbase is the largest, publicly traded as well, which is a digital assets exchange. Whereas at the NYSE, you can buy and sell stocks. At Coinbase, you can buy and sell various digital assets like Bitcoin and Ethereum and Solana, et cetera. A DeFi exchange does not operate in a centralized fashion. Coinbase is centralized, just like the NYSE. A DeFi exchange, such as MetaMask, is not centralized. There is no central authority. There is no single point of contact. It is completely eliminating the intermediary of the exchange or custodian or brokerage firm that is placing itself in between the buyer and the seller. In a DeFi exchange, there is no intermediary. The buyers and the sellers come together directly to transact. The largest is Uniswap, and the second largest is SushiSwap. And there are billions of dollars placed on both of these platforms as investors engage in trading without any intermediary engaged in the process. The largest such platform is MetaMask. And then the third is another version of tokens that are unique, and therefore they are called non-fungible tokens. To understand non-fungible, you have to first understand fungible. And just think about the dollars in your pocket. Every dollar is fungible. If I lend you $1, you can repay me next week with $1, and the dollar you give me isn't necessarily the same as the dollar I gave you. Every dollar's identical in every way, except for the serial number, and therefore they are considered fungible. It doesn't matter if they're the same that we use in transactions, but a non-fungible token is truly unique, just like a Picasso painting. And so we have begun to see a variety of non-fungible tokens, NFTs, being created, traded in the marketplace. Most famously, about a year ago, Beeple sold an NFT for $69 million. You now have tens of thousands of NFTs being sold in the digital marketplace. The largest exchange is called OpenSea, and you have everything from crazy little artwork to major pieces of art or videos being offered by professional sports teams, Hollywood stars, recording artists, and so on. And NFTs is now regarded as a very significant and, in fact, going to be the next dominant wave in the crypto world, because we're realizing that we can tokenize anything. So we're already tokenizing athletic contracts. You'll be able to buy a piece of your favorite athlete's income. We're going to be able to tokenize Bruce Springsteen's music because he just sold his catalog for $600 million. So did Bob Dylan and Stevie Nicks and so on. The next thing we're going to be tokenizing is all of us individually. You'll be able to tokenize your house. And instead of selling your house in retirement to generate money to support yourself, you'll be able to tokenize your home and sell shares of your home via NFTs of this. We'll be able to tokenize future income streams. We'll be able to tokenize virtually anything that we want. So the world of tokenization is the next big thing in crypto. And although we can argue that a lot of this artwork, like Bored Apes, are fads, the underlying technology that this is creating is not at all a fad. It's a here-to-stay trend. The bottom line is this. Whereas typical financial advisors have 10 or 20 asset classes in a diversified portfolio, the portfolios of the future will have 10 or 20,000 asset classes. The opportunity for truly unique, customized creation of portfolios in a way that has never been able to be done is all now going to be possible thanks to the technology of DLT and NFTs.
Thanks, Rick. So one thing to keep in mind, and I thought why it was helpful to go through talking about these different types of tokens is people talk about digital assets, they talk about Bitcoin, but there's a lot of variety between these various assets. So not just from, there's a technological difference between many of them. There's a risk reward difference between many of them. There's also, just fundamentally from a legal standpoint, a separate analysis in terms of are they securities or not. And the way that Bitcoin looks is going to be different from the way Tether looks, and it's going to be different from the way a Bored Ape NFT is going to look. So when you're thinking about, how does this fit in with the regulations and what my compliance obligations are, it's not enough to know that it's a digital asset or even that it's a digital asset, security necessarily. You kind of have to dig a little deeper, potentially, and look at, well, what is this thing actually, and how does it work, and how do people interact with it? So we thought we'd provide a little bit of overview in terms of, well, how can people get investment exposure to these assets? Obviously, actually, the biggest way that's not on here is, through without intermediaries, right? Directly going to Coinbase or another exchange, opening up a wallet, and buying the digital assets yourselves as a consumer or as an investor. But what about if you're interacting as an advisor? How can you provide exposure to your clients to this category of assets? And so we broke it down into three main areas. The first being what I think of as direct, which is the advisor either opens a wallet itself or opens a wallet for its clients that interacts directly with the exchanges, and the clients get direct exposure to either one or a basket of digital assets. And there are a number of advisors that are already using this model where they offer digital asset SMAs essentially to their clients. It does, I think, raise a number of regulatory issues that we'll talk about, including including the most fundamental one, which I'm going to keep coming back to, which is, are they securities, and how do you deal with that question? Do you, for example, decide, I'm just going to, for simplicity's sake, say that they're all securities, and I'm going to treat them all as securities for all purposes, and all my regulatory requirements that apply to stocks and bonds, I'm going to apply equally to digital assets? Or do you try to take it apart and say, well, a stable coin, that's different than a Bitcoin, and so I'm going to treat some of these assets as securities and some of them not as securities, which obviously is going to raise other regulatory issues. So that's the direct route, and we'll drill down a little more on some of the regulatory complexity there. But Rick's going to tell us about kind of these more indirect ways of accessing the assets.
You know, a lot of folks think that Bitcoin is not a security, so says the SEC, and therefore firms are struggling to be able to provide clients with Bitcoin because it's not a security, and that creates all kinds of questions from the firm's perspective. Therefore, I can't provide my client with crypto. That's simply not true any longer, because there are indirect ways that you can provide exposure to the asset class on behalf of the client. Later on, I'll give you some specific examples of that. But first, let me just say here, for the sake of this slide, that just as you could grow crops in a field to be a farmer, that doesn't mean it's the only way you can engage in agriculture. You could instead buy stock in Kellogg's, and that's a pretty effective way of being engaged in the agricultural business. And similar in crypto, you don't have to necessarily buy Bitcoin to be the only way you have exposure to the asset class. You could instead invest in companies that are building blockchain technology, or which are providing services to companies in the crypto space. For example, you could buy stock in Coinbase, a publicly traded exchange. So you're not buying Bitcoin, but you're buying stock in a company that makes its business buying and selling Bitcoin. You could buy stock in Riot Blockchain, which is a Bitcoin miner. And being a stock, it's a security and easily added to any brokerage account. So there are a lot of indirect ways that you can do this for the sake of gaining exposure in this asset class. It's what we refer to as the picks and shovels approach. You know, it goes back to Levi Strauss, who never mined for gold in the California gold rush. He instead sold blue jeans to the miners. And he became wealthier than any gold miner ever did. So don't buy Bitcoin, buy stocks of the companies that are helping facilitate the existence of Bitcoin. That's a picks and shovels approach, which is the indirect route. And there is no question from a regulatory or compliance perspective of your ability to do this, because you're just dealing with stocks or you're dealing with ETFs, and you do that all day long. So there's no question as to how to go about doing it from a compliance perspective. And then finally, our funds. And we'll talk more about these as well later, but there are a wide variety of mutual funds, ETFs, as well as private placements and SMAs that all engage in buying Bitcoin directly, but because they're doing it as a security, the fund itself is a security. So the fact that they're buying Bitcoin, ergo, makes that transaction a security. So just as you would allow your firm to offer private placements to a client, or OTC securities to a client, you could make these available to the client, and you'll treat them the same way you treat every other private placement or OTC security or private fund, because it's routine in the practice. The fact that the underlying asset being bought is Bitcoin is almost irrelevant.
So we're going to drill down on some of the compliance challenges of direct investing, and that's, I think, where a lot of focus has been in the legal community and also at the SEC. And, you know, you start with the same fundamental question of, you know, from a regulatory perspective, is the digital asset a security? The most talked about test, the most focused on aspect of the security definition has been the investment contract part of the definition of security. and the test under the Howey case, I'm not going to belabor it here because I feel like you could walk into like a digital asset convention of non-lawyers and you could ask them about the Howey test, and at this point they could all recite it back to you. It's almost like common knowledge now. But at any rate, whether something's an investment contract is of course a facts and circumstances type of analysis, and it's very difficult in my experience, any given coin, it's difficult to actually conduct an analysis that actually gets you anywhere from a practical standpoint, because you can do the analysis kind of any way you want. You can do it from the analysis of, I want this not to be a security, and I can kind of form my facts such that I think maybe it's not a security. At the end of the day, the SEC or litigation in court is going to tell you what the answer is most likely under the investment contract analysis. So it's very difficult as a legal compliance professional, I think, to use that analysis in a way that's actually helpful. On the other hand, there are some assets that people say, like stablecoins, for example, as Rick said, you don't expect a return on those coins. You put $1 in and you're expecting $1 out. And so under an investment contract analysis where profit is kind of a key component of what investors are expecting, you lack that element. And so a lot of people take comfort in the fact that under an investment contract analysis, a stable coin is not an investment contract. However, there are other parts of the definition that people need to be aware of. There are notes. We saw this with a recent action the SEC took against a company called BlockFi, where they basically said that the interests being offered by that company were both investment contracts and notes. And so that's an important component of any analysis. There's a category called evidence of indebtedness, which doesn't get a lot of focus in any way, really. I don't see it come up in literature. I don't see it come up in case law. However, it's there, and it's potentially a broad category, and it's something to think about when you're looking at these instruments. And then, of course, there's the other category, which is all the other things that are in the security definition. They do come up. For example, we'll sometimes see digital assets, tokens that are pegged to things like gold or silver. And there's actually a category in the security definition that's called a fractional undivided interest in mineral rights. Again, not a super used category in the literature or things that people are thinking about, but it's important to actually, if you are going to do an asset by asset type of determination of whether something's a security, I feel that it's probably important to go through the definition and look at each piece of it and say, could any of these things apply to the particular asset that I'm looking at? So it's a very basic, we're kind of at step one when we're looking at digital assets, which is, basic things like, are they securities? The reason it's important is that it has a ripple effect on everything under the Advisors Act, whether something's a security or not. So, for example, calculation of regulatory assets under management, the way you do that is you look at a portfolio to determine what percentage of that portfolio is comprised of securities. So whether a digital asset is or isn't a security is going to potentially affect your calculation and what the way your assets under management look, and could impact things such as are you registered with the SEC as opposed to a state. I'm going to turn it over a second to Tara, but another area where we see this is the Code of Ethics, personal securities transaction reporting. If you look at the rule says that people are supposed to report their securities that they hold. And so there has been a lot of discussion, at least among people I've talked to, about, well, do I have to know, therefore, if Bitcoin isn't a security, do people not report their Bitcoin holdings, but they hold, one of these other tokens like Dogecoin, do they have to report that because maybe that is a security? And and hey, by the way, my advisory firm, we don't even trade any of these assets, so why are we, potentially having people report on them? Because aren't we trying to keep people from engaging in front running and other types of misbehavior? So there's kind of like a policy aspect to this and a potential fundamental analysis aspect to it. And as I said, people can just decide we're going to treat digital assets as securities. We're not going to do an asset by asset analysis, and we're going to have people report. And then they get into questions of, well, are we doing anything with digital assets that actually implicates the rule? I'm going to turn it over to Tara because I think she's got some good insight into how the SEC is thinking about the rule. Yep.
Even if they come to the conclusion that it's not a security, attempt to address trading digital assets in their code of ethics. For one example, are the outside business activities that you might want to report, just to remind you to understand what's going on?
Yeah, so the question is, are people trying to address digital assets in their code of ethics even if they're not treating them as securities? And I think that actually feeds in very well with the comments I think Tara is going to have about how the SEC is viewing this issue. So I'll let her address that first. Yeah, finally.
Perfect timing. First, I just wanted to quickly note that my comments just reflect my personal views and don't reflect those of the commission or its staff. So that's a great question on the code of ethics. So the rule technically requires holding and transaction reporting for securities. But it's also important to keep in mind that the code of ethics reflect the advisor's fiduciary obligations. And with that comes the duty of loyalty and how is the advisor managing conflicts. So, for example, where you potentially have a supervised person and a client invested in the same asset class, is the advisor aware of a potential conflict? And if so, how is it managing that? So that's an important consideration to keep in mind when it comes to the code of ethics.
Yeah, so I think, to me, that says you don't really have to decide whether it's a security or not. You can, in fact, say, I suspect you could draft your code so that you say they are securities and so they fall into the reporting provisions that you already have. Or alternatively, we don't know if they're securities or not, so we just have it under a more general fiduciary duty section where you're going to look at conflicts, and if there's a conflict involving an asset class that's not a security, you're going to have, you're going to deal with it through reporting or some other way. But I think that's a live issue, and people are struggling right now with their codes of ethics because even if, as I said, even if the firm is not doing digital asset investing, probably your personnel are, and so you have to think about how you're going to address it.
Could I ask a question about that? Bitwise came out with a study a couple of weeks ago showing that nearly half of financial advisors are personally buying Bitcoin for their own account. Only 16% are recommending it to clients. So a lot of advisors are buying it personally. They're not doing it for clients. Does that create a fiduciary conflict? If I'm a fiduciary and I'm serving my client's best interests and I believe that this is a worthwhile asset to own, do I not have an obligation to share that with my client? And conversely, if I later did start to recommend it to my client, who now has to pay a higher price than what I paid when I bought it years ago, does that create a conflict? What disclosures are required? Do I need to say to my client, by the way, I own this and I bought it a few years ago. I never bothered to tell you about it, but I'm telling you about it now when the price is higher. With all of that, are there any issues from a conflict, disclosure, or fiduciary perspective?
Do you want to take that? Okay. Let me see if we could get an SEC view on that. But yeah, I think there is. So I think, as with any conflict, you have to think through, is the firm doing something for or against digital assets, that's different from what it's doing with respect to its clients. And if so, is there a conflict there, and what is it? And does it need to be disclosed in the ADV? Does it need to? Do you need to have some sort of mitigation strategy? Do you know what? How are you going to deal with it? The same way you would, I think, with any other type of conflict of interest. Okay, and then the last area I was going to mention on this slide was kind of this best execution notion. And what's interesting here is if you have a firm that is actually buying and selling digital assets for clients, you're most likely buying and selling through unregistered entities. You know, you're not buying and selling through broker-dealers most likely, and you're not buying and selling on registered exchanges. So you're going through Coinbase or Gemini or some other platform that is kind of outside the securities regulatory system, although they do have other types of registrations. So the question is, what is the advisor's duty vis-a-vis these other platforms and entities? You know, first of all, is it a disclosure issue? You know, should you be making sure clients know that these are unregulated entities, and that there might be issues, you know, for example, if the SEC were to go against any of these entities and shut them down, what impact might it have on client accounts? Also, you know, the different exchanges have different prices and pricing methodologies. So how are you going to determine which exchanges you go out to for purposes of buying and selling the digital assets? So I think it just raises issues with respect to how are you going to operationalize. You know, even if you say you're going to treat something as a security, that doesn't mean the ecosystem treats it as a security, and you still have to interact with that ecosystem. Okay, so one of, you know, I think probably a key area here with respect to compliance challenges, and certainly one that the SEC has openly discussed, is how to comply with the custody rule. You know, they've put out 2 releases that are specific to the custody rule in digital assets. One involving custody of digital assets and qualified custodian status, and one that was a broader request for comment on the custody rule as well as other aspects of regulation under the Advisors Act. And I'm going to turn it over to Tara to talk about that.
Yes, so the SEC staff put out 2 letters related to crypto custody. The 2019 letter, which seeks general comments on custody in this space, and then the 2020 statement, which relates to a no action letter that was put out by the Wyoming Banking Division. And both letters emphasize really what is the underlying goal of the custody rule, which is the safekeeping of client assets. And the letters highlight some of the unique features when it comes to crypto assets as we consider custody, one being the immutability of the blockchain, and another our use of the private keys. Immutability of the blockchain, this is the ability of the blockchain to remain permanent and unaltered. And unlike our current custody and settlement system where you have multiple intermediaries with their own sets of records and their ability to change transactions or address errors, you generally speaking don't have that with the blockchain. And certainly that immutability provides benefits in terms of transparency and traceability of transactions. For example, when it comes to the audit trail, that can help facilitate review of the transactions. But it can also present risks and challenges that we're thinking about. And we certainly welcome feedback from advisors on any issues they've faced when it comes to immutability. For example, have advisors had issues with erroneous transactions, and how has that been addressed? Related to the issue of immutability really are questions around the settlement process in this space. So how does settlement work where you're just dealing with the blockchain itself for on-chain transactions? And then where advisors are using intermediaries such as trading platforms, how does that settlement process work where you have both on-chain and off-chain transactions? Do the use of the intermediaries address concerns about immutability of the blockchain, or conversely, do they detract from some of the benefits of the immutability? On private keys, the public-private key pairing is something very unique in the crypto custody space. Hacking and thefts are certainly primary concerns when it comes to safeguarding the private key. But it's also important to note that there is the potential for loss as a result of negligence. You don't necessarily need an intentional bad actor for a private key to be compromised. And so how are advisors thinking about that? I think areas we're exploring at the staff level are have advisors and custodians gain comfort around processes for safeguarding the private key, and if so, what are they? Is the industry coalescing around best practices, and what are those? We've seen movement in recent years towards practices and protocols that use a mix of both hot wallet storage, where it's connected to the internet, and cold wallet storage, as well as multi-sig, so you have multiple parties involved in order to confirm a transaction, and MPC, so you don't have a single point of failure. And we're eager to understand from advisors' perspectives what have been the drawbacks and benefits of those various solutions. We also understand that there can be trade-offs when it comes to speed and ease of access to the private key to transfer assets versus storage methods that may be more secure but also may be more cumbersome or may take longer to transfer assets. And again, here we're curious to understand how advisors are thinking about those trade-offs and trying to strike the right balance. Two other items I would highlight in this space that are not explicitly mentioned in the letters are custodial contracts and insurance. On custodial contracts, we really do welcome input on what advisors think custodial contracts for this asset class should cover. Our advisors currently seeing gaps in this space that would leave advisory clients vulnerable. For example, in the event of a loss, are crypto custodians, are they generally disclaiming any form of liability? Or if not, if they are providing some sort of coverage, what are they offering? And then related to the issue of loss are questions around insurance. So what kind of coverage is available to custodians for this asset class? What are the prevailing terms for coverage? And importantly, how is it being disclosed to advisors? Do advisors and their clients have a good understanding of what losses are potentially insured and those that are not? So those are some of the issues that we're thinking through when it comes to custody in this space.
And a couple questions that I had for Tara were, are they getting a lot of feedback? Is the SEC getting feedback from the industry on these questions and on these requests for comment that it issued?
Yeah, so we've received some comment letters. They've all been posted to our webpage on the Division of Investment Management, but we welcome more feedback on these points.
And then the other question I had was, to the extent you're not getting a lot of feedback, what is the SEC doing? Are there people working on the issue? Is there going to be guidance forthcoming, or is the SEC kind of waiting for feedback before it issues guidance?
So custody is on the long-term rulemaking agenda at the Commission, and so because it is on the agenda internally, definitely we're thinking about these issues, but unfortunately can't comment any further than that.
So I would just add to this discussion, the qualified custodian issue, is something common to both the investment advisor space and the investment company space, but it seems like they're a little bit on two different tracks because you do have advisors out there using state trust companies as qualified custodians, although there may or may not be questions about how they're fitting into the definition of a bank. And and I think everyone in the industry, as well as at the SEC staff, is aware that there are advisors using those entities as custodians. Whereas for investment companies, they're still waiting to get the staff comfortable with the qualified custodian definition and how a custodian would actually not only be within the definition of a bank, but how would it operationally be able to safeguard the assets to the comfort of the agency. So I think there's still a lot of issues there, and I think the idea of interacting with the staff and giving feedback is probably helpful to both the industry and the staff, and ultimately any guidance that comes out is going to be informed by that comment.
Are there qualified custodians that do direct hold? There are?
Yes.
Is that slide list them on here?
Yes.
Just wanted to, the commission hasn't taken any position on what crypto custodians out there may or may not meet the definition, so.
So other areas of SEC concern include valuation, liquidity, manipulation, and fiduciary duty. And we're just going to run through these.
Yeah, sure. So in 2018, the staff put out a letter on investments, funds considering making direct investments in crypto assets. And then another letter in May 2021 for funds considering investing in Bitcoin futures, which identify similar issues for consideration. And these same issues, they can be relevant for advisors as they're thinking about providing recommendations in this asset class. So on valuation, the staff letters, they discuss the fundamental importance of accurate valuation. And similar to custody, there are just some really unique considerations that arise in this space. For example, price volatility. I think Morgan Stanley has put out some data that since 2018, Ethereum's 60-day volatility has been about 4 to 5 times greater than that of the S&P 500. So again, just an important factor to consider. There's market fragmentation, as Susan has mentioned. We have crypto assets trading on so many different trading platforms and protocols out there. And then you have unique features of airdrops and forks and how that can potentially impact a valuation analysis. Advisors in the private fund and SMA space, they can be impacted by valuation considerations as they relate to calculation of fund performance, calculation of assets under management, and advisory fees, for example. And then on liquidity, the May 2021 letter poses some detailed questions about liquidity in the Bitcoin futures market and how funds can meet their redemption requests. And the 2018 letter highlights questions around how to classify liquidity given price volatility, trading volume, trading history, and market fragmentation. The fiduciary interpretation from 2019 also touches on liquidity in a few places. So as part of an advisor's duty of care, the advisor must have a reasonable belief that its advice is in the best interest of its client. And informing that reasonable belief, an advisor may want to consider how liquid the market is for a particular crypto asset and how that compares to the client's investment objectives, their risk tolerance, as well as their investment time horizon. And with that, I'll turn it over to Susan on manipulation.
Yeah, so obviously the commission's had a lot of concern about manipulation in the underlying digital asset space. And that's been one of the roadblocks for some of the exchange-traded products that have been trying to get approval. But I think it goes beyond those products in terms of the concern that there is potentially, manipulation happening in the industry, and it's not, as regulated as some of the other spaces where people are trading. So I think that feeds into the fiduciary duty concern with respect to how are you thinking about the assets, how are you disclosing the risks, and what type of analysis are you doing with respect to your clients as to whether this is an appropriate asset class, or or even on a more asset level basis, is this particular asset appropriate for the type of clients that we're providing services to, and do we have appropriate disclosure with respect to any risks? Okay, so now I'm going to turn it over to Rick. He's going to give us another perspective, which is kind of like how can you access the asset class without having to deal with all of these concerns that we just went through.
Thank you, Susan. From everything that we've heard, it certainly sounds scary to contemplate a policy that allows advisors and reps in your firms to recommend Bitcoin and add Bitcoin to client portfolios. So don't do that. I fully agree that it is way too complex. There's too much uncertainty, lack of clarity for all kinds of reasons. So that doesn't mean that you can't access the asset class. Instead, go the indirect route. In other words, don't try to buy Bitcoin from an exchange or Ethereum or any other coin or token. There's too much uncertainty as to how you can do that in a compliant way. So don't do that. Instead, just stick to securities. We all are dealing with securities every day, stocks, ETFs, mutual funds, sometimes private placements and SMAs and TAMPs. Just stick to that. The fact that a stock might be engaged in the industry of crypto doesn't really matter a whole lot. That becomes an investment management question as opposed to a compliance question. And you know how to provide due diligence and the compliance analysis on securities. So just apply that metric to this. As you're trying to evaluate, do I want to invest in do I want to allow an ETF to be on my platform that an advisor can recommend to a client? You would evaluate that ETF for all kinds of metrics. Is it what's its methodology, what's its history, what's its pricing, what's its turnover, who's the management, all those kinds of details. You do the same thing with a crypto ETF. And then because this asset class is totally new and different, which has really nothing in common with stocks, bonds, real estate, gold, oil, commodities, et cetera, we need to make sure that the advisors are trained, as well as the home office staff. We need to make sure compliance and legal are trained, that sales management is trained, that HR is trained, that operations are trained, because this asset class is unlike any other. So we need to provide training to everyone in the firm so that they are fluent in this subject, the same way we would require them to be fluent in annuities before we let them sell annuities. And once we have that training in place and the firm has an approach, then we can go about this in a much more compliant, confident approach, because we're applying the same compliance methodology that we do in every other aspect of our practice. So this eliminates a lot of the uncertainty that would otherwise exist. And I can blow through a really fast series of slides for you on the different ways that you can do this in the indirect route, if you want me to go through those.
Do you mind if we just instead see if there are any questions first? Any questions? We have a few minutes. Yeah.
So what are the aims of the SEC with evaluating different token distribution methods like airdrops and token sales, given that a lot of USC investors are currently able to participate in those distribution methods?
And are you trying to get at the valuation point, or is this about?
I don't think it goes through the evaluation, but I think obviously the underlying goal is to evaluate whether it can be considered a security. But obviously there's a lot of gray area.
Yeah. I think it goes back to the points that Susan was making. There are existing frameworks for analyzing whether or not something is a security. Go back to Howey, go back to Reeves, and apply the framework, and it becomes a facts and circumstances analysis at that point. And there is I'm not sure if it's mentioned in the slides, but the Division of Corporation Finance put a framework for analysis for crypto assets and how they potentially might fit in with the definition of security, I think from 2018. So that can also be a reference point, yeah.
This is maybe not a question, but a statement when it comes to crypto, but one of the challenges that we see, but possibly, is that when a client comes in from a
I can tell you, from a financial planning perspective, if a client comes to us and has a significant holding or any holding, we would treat it like any other asset class. Very routinely, clients own real estate, investment real estate. They have rental properties. Those aren't securities. They often have collections. They have a rare wine collection. They have stamps and coins. They have artwork. And we would evaluate that as well to ask, are you overweighted? Do you have too much of it relative to your net worth, given the lack of liquidity or the other unique risks inherent in that asset? Do you have proper insurance protection? Have you incorporated it into your estate planning, meaning what's the account registration? Have you included it in your wills and trusts and related documents, and so on? So we would not necessarily be recommending that you should own or not own because we have a belief or disbelief in it as an asset class. We would do it as part of an overall asset allocation. Are you overweighted? Are you underweighted? And are you aware of the implications from a financial planning perspective? We treat it the same way as we would
So-
rental real estate.
We're out of time. Let me just tell you very quickly that the second code word for continuing education is robot. We're going to be up here and at the lunch, so if you have questions, feel free to ask us after we all exit.